Welcome everybody, and thank you for attending our new webinar on Brexit, Taking the Pulse of the UK Economy. My name is Katharina Utermöhl, and I'm a Senior Economist for Europe at Euler Hermes. 16 months have passed since the majority of the British people voted in favor of leaving the EU. Today, let's take a look at how this decision has already weighed on growth prospects for the UK economy. We'll also look at where the UK currently stands in the Brexit process, what a future trade deal with the EU could look like, and what the likely long-term implications for the UK economy will be. At the end of the webinar, I'm happy to answer any questions you might have. Please don't hesitate to already submit them now during the presentation using the Q&A widget. I will try to answer as many questions as I can during the webinar, but in case that we're running out of time, I'll get back to you via email as soon as possible. Now, let's start by taking the pulse of the UK economy. Last year's Brexit vote certainly did not trigger the much feared doom and gloom economic scenario for the UK. Nevertheless, the prospect of Brexit is having an adverse impact on economic activity in the UK, and it's increasingly becoming more visible. Namely, whereas in Europe, generally speaking, economic momentum shifted up a gear in the first half of 2017, and short-term economic indicators such as the Purchasing Managers' Index, pictured here on the right-hand side, suggest that momentum will remain strong going forward, the UK economy is increasingly struggling to keep up with its Eurozone peers. In fact, while we forecast Eurozone GDP to grow around 2% in 2018, for the fourth consecutive year, the UK economy is expected to expand at only about half that rate, namely 1%. Hence, while the Brexit vote did not trigger a sudden economic death, the UK economy is experiencing a clear, albeit gradual, slowdown. Now, let's take a look at the individual components of GDP to better understand why we expect UK economic momentum to cool further in 2018. First, we'll focus on the UK consumer. The impact of the Brexit vote has been immediate and unambiguously negative for UK consumers. As we can see on the left-hand side, consumer spending has clearly lost momentum in the past 16 months, and the ongoing decline in consumer confidence suggests that there's more pain ahead. But why are consumers so pessimistic? For good reason. For one, the sharp depreciation of the pound following the Brexit vote has made imports much more expensive, which in turn pushed up consumer prices. In September, annual headline inflation reached 3%, the highest rate in 5 years, weighing on consumers' purchasing power. In addition, wage growth, which has proven sluggish for a while in the context of low productivity growth and a rise in low-paid jobs, is failing to keep up with consumer price increases. As a result, the UK is in fact experiencing negative real wage growth, which is bound to weigh on household spending. And what is the outlook for 2018? Well, with inflation expected to remain above 2.5% next year, as the sterling weakness continues to feed through to consumer prices, and no sign of wage growth picking up anytime soon, consumers are bound to feel the pinch also next year. Next up, let's take a look at investment activity. The impact of the Brexit vote has so far been quite limited. In fact, investment remained resilient, and surveys suggest that firms in the manufacturing and service sector even raised their investment intentions in the first half of 2017. So what is behind this trend? Are firms underestimating the adverse economic impact of Brexit? We have identified several reasons responsible for the resilience of UK investment. For one, investment plans for 2017 were not aborted, given no immediate consequences of the vote. Number two, domestic demand did not fall off a cliff, but has proven relatively resilient up to now. Number three, some export-oriented firms, in fact, are upgrading their investment intentions with a view on profiting from the fall in sterling. And lastly, some firms have not yet planned ahead for Brexit, which is understandable given that they don't quite know what to prepare for. Nevertheless, a slowdown in investment is already underway. The normal rate of investment growth in good times has been close to 5%. And right now, we're definitely below this rate. And we expect the slowdown in investment growth to become even more pronounced as the domestic economy continues to cool in 2018. Now, let's look at the final piece of our short-term growth picture for the UK economy, the external factor. Now, with domestic demand cooling, is there hope for a boom in UK exports to make up for slowing household consumption and investment? Unfortunately, so far the sharp depreciation of sterling has failed to boost export growth, and we don't expect it to do so anytime soon. In fact, UK exporters, rather than hoping to sell more goods at a lower price, have raised export prices in tandem with the depreciation of the pound, as you can see in the graph on the right-hand side. Hence, exporters have opted to maintain profit margins rather than go for volume. Key factors in this decision may have been, for one, the high import content of UK exports, meaning that rising import prices called for an upward revision to UK export prices to relieve pressure on profit margins. And number two, the low sensitivity of UK exports to the exchange rate. After all, the UK tends to export higher value goods and services that are less sensitive to the exchange rate. Hence, with the external sector unlikely to provide a helping hand to make up for softening domestic demand, overall UK GDP growth is bound to slow further going forward. Now that we have looked at the UK economy's short-term growth prospects, let's recap what Brexit actually means and where the UK currently finds itself on its path to Brexit. Triggering Article 50 in March started the 2-year countdown for EU exit negotiations. After 44 years of membership, disentangling Britain from the rest of the EU is proving highly complex. The divorce negotiations cover 3 main issues. Number 1, people, as in protecting the rights of citizens. Number 2, money, as in agreeing on the UK's outstanding financial responsibilities to the EU. And last but not least, the border issue, with the key aim here being to avoid a hard border between Northern Ireland and Ireland once the UK leaves the EU customs union. Once sufficient progress has been made on the exit deal, the second stage of talks can begin. The negotiations on principles underpinning future EU-UK relations. To allow sufficient time for ratifying the divorce agreement by March 2019, when the UK formally exits the EU, a deal has to be in place within the next 12 months. This will not be sufficient time to hammer out a full-fledged trade agreement with the EU. Hence, we see the need for a transitional deal that applies from March 2019 onwards and allows for more negotiation time. A new steady state in EU-UK relations will only be reached in 2021 at the earliest. And this is a good 5 years after the Brexit vote. In addition to the direct negotiations of its relationship with the EU, the UK will also have to negotiate more than 700 international treaties, which the EU had signed over the past decades on its behalf, including more than 50 free trade agreements with non-EU countries. A momentous task. Now let's focus on why it's a good idea to have a transition deal in place when the UK exits the EU in March 2019, and why politically it remains a tough sell. Given time constraints and an EU preference to avoid cherry-picking, we would expect the transition deal to be something straightforward that much resembles the status quo of EU membership. Essentially, this would see the UK enjoy continued access to the EU single market during the transition phase, essentially pushing out the cliff edge into later years, thereby providing UK but also EU businesses with much needed planning certainty. A transition deal would also allow more time to negotiate a future EU-UK trade deal, and in our view, it would further lower the probability of a no-deal scenario. On the downside, though, from a UK perspective, a transition deal would keep the government from imposing migration controls or entering into new trade deals with non-EU countries for the duration of the transition period. And while the UK will have to continue to adhere to EU laws and regulations and continue to pay into the EU budget, it will no longer be a member of the European Union after March 2019 and hence would lose its voice in shaping EU law and become essentially a rule taker. In a nutshell, a transition deal would mean that Brexit takes place only in name in March 2019. Meanwhile, taking back control would have to wait until the end of the transition period. So, how does a transition deal alter the economic implications of Brexit? A transition deal clearly limits the negative economic impact around the time of Brexit. Our calculations show that without a transition deal in place in March 2019, we would expect GDP to contract markedly that year by about 1.2%, with investment and exports hit the hardest. But also private consumption would decline in the UK. Meanwhile, in contrast with the transition deal in place, economic momentum would only slow marginally, driven by somewhat lower exports and investment. But overall, the economy would continue to post positive economic growth of close to 1% in 2019. A transition deal would hence make economic sense by helping to avoid economic chaos and disruption around the time of Brexit. However, a word of caution, it cannot eliminate the negative impact of Brexit altogether, but rather moves the cliff edge into later years when the final EU-UK trade deals start to apply. Now, a transition deal is a good thing to have, but obviously it begs the question, to where? It still remains very difficult to analyze the UK's strategy for life outside the EU, given that the political debate in the UK is still ongoing. Prime Minister Theresa May has said she's looking for a creative solution, a bespoke agreement, somewhere between the Norway and Canada models. However, when looking at how the Conservative Party interprets the Brexit vote, the range of options is greatly reduced. The number one concern still seems to be that of controlling migration, particularly for unskilled labor. And this really leaves the UK with only one option, a free trade a la Canada, assuming that a no-deal scenario which would see the UK trade under WTO terms is not really desirable. After all, the four freedoms of the EU single market are deeply connected with each other and cannot be offered separately from each other. A free trade deal, modeled after the one between the EU and Canada, would suit the UK government given that it does not call for budget contributions. It would allow for the imposition of migration controls, and it would no longer subject the UK to EU law and regulation. Moreover, it would leave the UK free to strike trade deals with non-EU countries. At the same time, though, such a deal a la CETA would severely restrict the UK's access to the single market compared to what it currently enjoys. Given that 40% of UK exports are absorbed by the EU market, the economic price for Brexit will be significant. Now let's have a look at our key scenarios for the future EU-UK trade agreement. Our baseline scenario is that of a limited free trade agreement, to which we attach a probability of 55%. In this scenario, selective sectors would go duty-free, while others would be subject to non-prohibitive tariffs. The weighted average tariff would reach 2 to 3% on goods, and we would expect there to be few service sector add-ons. As a result, we forecast tariff equivalent additional costs of 10% on average. To keep in mind in this scenario, over time, non-tariff barriers will build up as regulation and standards start to diverge. The second scenario is that of an extensive free trade agreement, to which we attach a probability of 25%. The probability of such a scenario is relatively low. After all, granting the UK such a high degree of access to the single market would probably not be a good move in keeping the European Union together without risking copycat movements. Particularly if the UK continues to insist on imposing migration controls, the scenario of an extensive free trade agreement remains highly unlikely. In this scenario, most goods, notably in strategic sectors such as automotive, energy, chemicals, pharmaceuticals, as well as agri-food, would be tariff-free. Moreover, this scenario would include substantial service sector add-ons, which would only add an additional cost of about 3%. Now, the third scenario is that of a no deal, the WTO option scenario, and we attach a probability of 20% to this. It is the least likely scenario. This is because it's neither in the interest of the EU nor the UK for such a scenario to materialize. However, we cannot rule it out altogether. In particular, we would see such a scenario emerge more as a result of a weak and divided UK government rather than an intentional choice. In this scenario, the most favored nation principle would apply, which would imply tariffs to the tune of 5% on goods. Meanwhile, the service sector would lose passporting rights and equivalent status would be hard to establish. Therefore, we would forecast additional costs to the tune of 20% to 30%. Now, what does it mean in terms of economic implications in each scenario? What is the long-term view for the UK economy under the different options? Well, in fact, no matter what the new trading relationship will look like between the EU and the UK economy will be clearly worse off in the long run. In all three scenarios, we expect potential growth to decline. This is due to three key factors. Number one, restricted access to the single market. The UK's withdrawal from the EU is just like putting up trade barriers and therefore weighs on the UK's competitiveness with its largest trading partner. One key aspect here to remember is that geographic proximity is the key determinant of trade patterns. Hence, we don't really see the upside case of new trade deals making up for reduced trade with the EU. The second key factor is lower investment, domestic as well as foreign. After leaving the EU, the UK's attractiveness for foreign direct investment is bound to decline, given that it can no longer act as a platform for international firms seeking to serve the EU market. Domestic investment, meanwhile, will slow in line with cooling domestic demand. The third key factor is reduced labor inflow. Restricting immigration will seriously prevent access to global top-tier talent, causing major problems, especially for creative industries. The record low unemployment rate and record high employment levels, meanwhile, that we're witnessing in the UK currently, suggest that the economy's potential will come under pressure if labor inflow is reduced markedly. Overall, potential GDP growth will be substantially lower in all scenarios. For our baseline scenario, we expect the economy's potential growth rate to more than half, to 1.3%. We have reached the end of the webinar. Thank you for tuning in. We'll now move to the question and answer section. If you have not yet submitted your question, please do so now using the question and answer widget. So I will turn to the first question now. The first question is whether we should have another vote once the terms of exit are finalized. Making such a decision now would give the politicians a chance to prepare for a referendum. I think given the slim majority in last year's referendum, the UK population should be given another chance to weigh in, even if only to deny the government a blank check on the terms of the departure. It's better to announce a second vote on exit terms now so politicians can prepare, because this would certainly reduce uncertainty, in contrast to a situation where such a demand would only come up in 2019 suddenly. And as laid out in the webinar, from an economic point of view, it would certainly make a lot of sense for the UK to remain in the EU. Hence, from that point of view, I would certainly welcome a reversal of the decision. Now let me turn to question number 2, which is whether the crisis in personal debt, especially amongst the younger population, is serious enough to be another bursting bubble. So, as touched upon during the webinar, households are already in a tough spot. So consumers are feeling the pain given rising inflation, sluggish wage growth, and in addition, the expected decrease in housing prices, as well as anticipated increases in the interest rate, will put further pressure on consumers. So household debt is already high, and it's still growing, which leaves consumers vulnerable to an economic downturn, which we are anticipating in the case of a Brexit. So consumer debt has actually risen above £200 billion. The new rate of credit extension is slowing down, but it is still a concern. So banks are currently under pressure from officials at the Bank of England and the FCA to clamp down on low-quality loans to households. We believe, given that there's this kind of focus, that this would help rein in the excesses, and we would hope that we will not face a bubble. But given the deteriorating economic outlook around Brexit, certainly this is a risk to watch. I will turn to the next question, which is whether increases, or whether restrictions in labor increases, how this would affect wages in the UK. So yes, curtailing migration is certainly a key demand, or this is how the Conservative Party interprets the vote, and hence this is something that they definitely want to implement. Now, if you have lower labor inflow, you would think this could exert upward pressure on wages. However, currently there are two factors holding down wages, and this is the high increase in low-paid jobs, for one, and then also low productivity. Hence, especially the second aspect, low productivity growth, will have to be addressed in order for wage growth to really take off. Moreover, as part of our Brexit scenario, we expect the economy to slow down. And this would, and also on top of this, the Brexit-related uncertainty would not really support an acceleration in wage growth. Hence, we think that the prospects for wage growth taking off are pretty dim. Now I will turn to the next question, which is whether Brexit will have any impact on the interest rates. So we can already see that Brexit is having an impact also on monetary policy. Of course, just after the decision, the central bank stood ready to make sure that financial stability can be safeguarded in the UK, and they did a tremendous job at dealing with the Brexit shock. But with regards to the interest rate policy, it's also having an impact. So as touched upon in the webinar, we saw that the sharp depreciation in the pound has fueled the increase in consumer prices. And with inflation coming in at 3% in the month of September, the Bank of England has announced that they're more likely to raise rates in the coming months. And hence they have actually changed their stance. So this would be the first interest rate hike in more than 10 years. And this is because for a long time the Bank of England actually tried to strike a balance between protecting economic activity on the one hand and also safeguarding price stability. and now with inflation due to the depreciation of the pound rising a full percentage point above the target of the Bank of England, which is 2%. Actually, we think that safeguarding price stability will become the main focus point. And there we can see it has already influenced monetary policy. Moreover, if really a negative scenario materializes where there will be additional pressure on the sterling exchange rate, that could also warrant a move by the Bank of England in order to make sure that there's not a currency crisis. But this would be for a very negative scenario. In addition, if now, and one more scenario that I can imagine where Brexit will have an impact on monetary policy is also with the economy slowing, the Bank of England could at some point opt for looser monetary policy again to support economic activities. So yes, the Brexit decision has had a significant impact on monetary policy and will continue to do so going forward. I will turn to the next question, which is what would be the impact of a no-deal scenario on the Eurozone economy. So yes, we have also calculated the export losses for the individual Eurozone countries, as well as, well, actually for all the significant trading partners of the UK. And we also expect some losses, of course, for its EU partners. But these turn out to be quite different depending on trading flows, of course. So the export losses in a no-deal scenario would, for instance, for Germany, come in at about 7.7 billion euro, and compare that, for instance, to Spain, where export losses would come in at 1.7 billion euros. So you can see the impact of a WTO scenario varies quite significantly depending on what country you look at. But overall, the losses do remain rather moderate. So we have run the calculations also in terms of the loss of GDP growth, for instance, for countries where we would expect high impact. Again, this would have to do with close economic ties, such as Germany and or the Netherlands. And for Germany, for instance, we would only expect GDP growth to decline by 0.4%. To come in a little bit weaker by 0.4 percentage points over the period of 2017-2021. So the losses are actually very moderate, and if we compare this to the WTO scenario and the economic implications for the UK economy, we do see that it disproportionately hurts the UK economy more. Now let me turn to the next question. The next question is, what implications are there for public infrastructure spending between 2017 and 2021? So in general, we think that, well, we have already seen there have been some public support programs to public infrastructure support programs that have been announced earlier this year. And we think, especially if the economy slows going forward, which is our base case, we think that public infrastructure spending could increase to support the economy. But at the same time, public finances will also come under pressure by the Brexit vote. Hence, this will keep a lid on possible public spending on infrastructure. But in general, we think this could be one avenue to support the economy on behalf of the government. Let me turn to the next question, which is, in the Eurozone, growth is stable. Are we likely to see this continue throughout the Brexit negotiations? So our forecast for the Eurozone for 2017 and 2018, I've mentioned during the webinar already. We expect the economy to grow at about 2%, and we think this is part of a cyclical upturn, and we would expect economic momentum to weaken a little bit beyond 2018, hence let's say 2019 and beyond. So it's not quite at 2%, but a little bit below. But overall, the recovery after the Eurozone debt crisis continues to move on, and prospects are quite favorable. We don't think that Brexit negotiations will really influence this outlook significantly. As mentioned, even in our most negative scenario, in the WTO scenario, we expect EU losses in terms of exports, but also GDP growth, as well as because of this negative scenario, to be moderate. Again, this might differ depending on what country you look at, but overall, the losses should not be significant at all. Hence, we would not expect this to influence the Eurozone growth outlook. I will turn to the next question, which is, how high might unemployment go? Now, in the foreseeable future, we don't see unemployment increase significantly, actually. This is because we're not looking at a sudden economic death, but rather a gradual but continuous slowdown, a cooling down of economic momentum in the UK. Hence, and also if, as in our base case described, the transitional deal applies from 2019 to 2021, also then we would think that there's no sudden economic shock, right? As I mentioned, it would move the cliff edge forward. But overall, unemployment will rise as the economy continues to slow. Now, this will balance to some degree with the reduced labor inflow. So this would keep a lid on the increase in unemployment. But at the same time, as mentioned, we are also losing access to talent. Hence, we would maybe see an increase in unemployment in certain segments, in particular, let's say those that are particularly hurt by the UK leaving the EU. Hence, this should vary. But we would see unemployment not rise above 5 or 6% by the end of 2021. Let me turn to the next question, which is how do you see the exchange rate evolution between the euro and the pound? So as of today, 1 pound, the exchange rate is at 1.12. Our forecasts, of course, very much depend on which scenario for Brexit will materialize. In our baseline scenario, or let's first start with 2017. Actually, we have not adjusted our forecast since earlier this year. We expect the exchange rate to come in between 1.12 and 1.15 at the end of this year, which is close to current levels. And we would expect a further depreciation next year. Again, given the uncertainty, the range that we're looking at is 1.05 to 1.10. Now, the big divergence in our forecast then comes with 2019 and the years beyond. given that we would then see in what direction Brexit will take the UK economy, or what kind of Brexit we will experience. And here in our base case, we would see the pound close to parity with the euro at 0.97 or 98 in 2021. Now, let me turn to the next question. This is again a question about the exchange rate, whether we are currently judging the pound as significantly undervalued. I would say no. We have seen, in fact, rather that it has that probably we saw some overvaluation in the run-up to the referendum or in the years before. I think also given the exchange rate forecast that I mentioned earlier, we actually expect that there is still not significant, but there's still some room for further depreciation. Hence, I would not see the pound as undervalued at this point. Let me turn to the next question, which is, would cancelling Brexit trigger a boom in the UK economy? I think, well, there is talk now about a scenario where Brexit, or let's say where the exit terms are again voted on, whether, for instance, in a second referendum, and that maybe there will not be a majority actually in favor of that kind of Brexit, and that the decision is reversed. And given that we would already see, so let's imagine that such a vote would take place at the end of the divorce negotiations, so in 2019, in late 2018 or early 2019. And if then there's a majority actually against Brexit or the specific Brexit terms, but then this would call into question the entire move, then I would think that this would trigger a boom in the UK economy. We have already seen what the prospects of leaving the EU has done to the UK economy. We have discussed it earlier. We have seen that domestic demand has slowed down, and we will see this continue, this trend in 2018, and in particular with domestic demand, so consumption and investment. And if then suddenly there is a reversal, we would think that actually investment maybe that had been held back would flow into the economy, and we would see an acceleration in momentum again, and this would also benefit households. Hence, I mean, I don't know if you can call it boom, but certainly this would be a clear positive for the UK economy. Now, let me turn to the next question. The next question is whether there would also be, how do we view the possible impact on EU exports to the UK without any trade deal? Surely the same tariffs would be imposed on EU goods. So yes, this is part of our scenarios. So if we would, in a no-deal scenario, as mentioned earlier, we would also see a negative impact for EU countries, and this would also have to do with the imposition of tariffs on EU goods. So this would hurt exports of goods and services, as well as GDP growth, and so in general would not be a positive for the EU economy, but given how much the UK actually imports from the EU, this would still hurt the UK much more. So one example that I learned the other day is that in a regular supermarket in the UK, actually 80% of the goods are imported, and so this and most of this comes from the EU. Hence, it would hurt the UK disproportionately more. I will turn to the next question, which is, can we expect to see further devaluation of the pound against the euro in the coming years? So I apologize, I've already answered this. Yes, so just to recap quickly, until 2021, in our baseline scenario, we would expect the pound to go close to parity. Hence, further depreciation is built into our baseline scenario. And just to mention this also, even in the upside scenario, let's call it, of the extensive free trade agreement, we would not see the pound appreciate from its current value with regards to the euro. So even in this upside scenario, we would see the exchange rate to come in at 1.07 to 1.12 in 2021. So even there, we wouldn't see any appreciation potential. Let's go to the next question, which is, have you come across any research which suggests a long-term benefit to the UK from Brexit? So I have to say I have not come across any serious research that suggests this. So you have seen that we overall think that the UK will be clearly worse off in the long run, and even in the case of our upside scenario of the extensive FTA, I have yet to come across the reasons why the UK should be better off. In particular, I didn't elaborate so much on that during the webinar, but in particular, replacing the trade that the UK currently does with the EU will be so difficult to do, because it is, as mentioned, it's in particular the proximity of nations that determines the degree of trade that they do with each other, and it will be just hard to see who the UK would replace the EU market with. Hence, no special relationship with any other country should make up for the distance or for this lack of proximity. And so I find it very difficult to see how the UK would want to be a global Britain and succeed and return to its current strength right now. Also, just to mention one aspect, which is sometimes where some hopes are connected to, which is that the UK becomes the Singapore at the Thames, right? So would lower regulations and standards and maybe tax rates in order to become a globally competitive, possibly tax haven that can also be successful in the long run. I do have my doubts about this strategy. For one, there is no real political support for deregulation. Hence, workers' rights, health and safety, and environmental standards are really important to the British people. And moreover, in order to trade with the EU going forward, you would still have to apply those standards, right? Otherwise, you can totally scrap the trading relationship with the EU if you diverge from these standards. And then the hope is, again, like to become the Hong Kong of the 70s. Well, I think that the Hong Kong of the 70s wasn't really characterized by closing your borders or reducing the inflow of people, and with that also the inflow of ideas, and but rather it was open to trade, open to investment, open to labor inflow, open to idea. And hence, as Adam Posen, another economist, has said, this would actually take the UK not back to the Hong Kong of the 70s, but to the UK of the 70s, which, economically speaking, maybe what isn't the most favorable place to be. So no, I have yet to come across analysis that shows that the UK or that Brexit will make the UK more competitive or more successful in the long run. Now we will come to our final sentence, our final question, excuse me, which is, which probably just came as a reaction to the last question. Trade works two ways. So who will the EU replace the UK with? So again, this is true. It works both ways, and trade will go down, meaning that the EU also will export less to the UK, of course. But overall, this will hurt the EU economy disproportionately less compared to the UK, which would have to take the full weight of the reduction in one country. Meanwhile, for the EU, this would be split across 27 nations. Hence, the economic impact would be that much more detrimental to the UK. Overall, what is just strange, again, is that the UK says it still believes in free trade and it wants to spread these values. But meanwhile, it does leave, or it does exit the largest free trade area in the world. So it is just really hard for me to still to understand why it does that. So I think, again, this the UK will feel the bulk of the negative impact, and it will take a long time to replace the trade. Meanwhile, for the EU as a whole, the impact will not be as negative. Now, we have come to the end of our webinar. Thank you so much for tuning in. If I did not get to answer your question just now because we ran out of time, I'll get back to you via email as soon as possible. I'm looking forward to seeing you or welcoming you on our next webinar. Have a good day.